Live from the JPMorgan China Summit here in Shanghai, this is Insight with Haslinda Amin. The global economy is at a crossroads with rising geopolitical tensions, an energy and inflation shock, and trillions of dollars pouring into AI. Despite these massive risks, a relentless tech rally has pushed stock markets to record after record. Cracks are now starting to appear, with bond markets sounding the alarm, but stock bulls are charging ahead, wearing AI-powered blinkers. Just ahead, I speak exclusively with JPMorgan CEO Jamie Dimon. He remains one of the most prominent voices in global finance, calling for caution, warning there is simply too much exuberance. We're wasting no time. Let's get straight to our exclusive conversation with Jamie Dimon, Chairman and CEO of JPMorgan Chase. Jamie, good to have you with us, and thanks for having us here.
Happy to be here.
The bond market is front and center. We're seeing yields at the highest levels in decades, yet we see the stock market keeps rallying. In fact, it's again in the money today. Should we be nervous or not?
Well, I think it's always reasonable in the investing world to be nervous a little bit, because you've mentioned the opening. There's a lot of geopolitical risk. You have a bunch of wars going on, which I hope are properly resolved. You have bond rates going up. Inflation is a little bit higher than people thought. So yeah, but I'm not surprised. I think when people say you should be surprised, bond rates can go up. The notion that somehow people said they'll never go up is the wrong notion. And so companies like us prepare for higher rates, lower rates, and figure those things can happen. So
the thing is, they're at the highest level in decades. I mean, that is where the surprise could be.
I think they could be much higher than they are today.
Oh yeah?
And
how much higher?
You say decades, but we've had like one of the greatest bull markets. Other than brief COVID, since the great financial crisis, we've had a huge bull market, huge lower rates for the most part for a long period of time. But the world changes. Like we may have gone from a savings glut to not enough savings. The AI investments, you're talking about in America alone, $450 billion last year, $750 this year, $1 trillion next year, global deficits at all-time highs, and they are huge. So the governments, including ours, has to borrow huge sums of money, more next year than this year. And so, people who own bonds, they tend to look at these things, and both inflation and demands for capital can push up rates.
The thing is, it's not just an inflation story right now. It's also, I guess, a credibility story, right? I mean, we have an environment where everybody's trying to pay debt, and governments around the world have so much debt at a higher level. I mean, at some point, it's going to hit.
Yeah, it is going to hit. Like, U.S. government debt is $30 trillion. The average rate is 3.5%. So even today, they can't possibly refinance it at lower than that rate. They have another $2 trillion to do this year. So yeah, but the thing is, we don't know when. We don't know when the world gets too scared about that. When inflation makes it where people don't want to own long-term duration securities, or when it's just a demand for capital. There have been examples in history where there's so much demand for capital, rates are going up, but it's for a good reason. People are making productive investments in the world. Government spending is often not that. Government spending is much more consumption-related, which doesn't help future productivity. So, and all that spending too drives corporate profits. So people shouldn't be that surprised that corporate profits are doing quite well too, which helps obviously the stock market.
The question, I guess, if I could get you to look in the crystal ball, right? At what yield would that be spillover to the economy, to policy, to markets?
Yeah, so I'm very cautious about crystal balls because I don't think anyone has a crystal ball. We look at all potential possible outcomes, and you'd be surprised, from recessions with inflation, from recession with no inflation, from home prices down 40%, stock prices down 40%. It's a wide range of outcome. I think when people think this is our forecast, that's what's going to happen, I think that's an intellectual error. I think you should be much more thinking about range of outcomes, possibilities, probabilities. And for us, we want to handle all of them so we can serve our clients. So I'm not that worried about, our profits going down and the stock going. That doesn't worry me at all. I want to serve our clients and do a good job. And I do worry about the geopolitics for the future of mankind. That's a far more important issue in my mind. But just looking forward, I think my own view, and it's just different than other people, is that rates can easily go up more and credit spreads can go up more. If people have
everything's going to be okay, even with rates going up more?
No, at one point you can have a lot of people who have to refi at higher rates. So there's this general assumption that, I can refi all this debt at roughly the similar rate. Well, if credit spreads go up, people, companies, and governments will have to pay more. And so that can put stress in the system and easily could cause a recession type thing. Again, I'm not terrified of recession other than, it hurts people who get laid off. But I think as a scenario, that's a very possible scenario.
There are risks. People have called time on the credit market. If yields continue to rise, there'll be a lot more pressure on the credit market.
Yes.
How might that play out?
Well, a lot of companies are leveraged. There's about $5-6 trillion of leveraged loans out there. They're going to have a hard time refining at those rates. The equity values will be considerably less. Some will be prepared for it. Some hedge for it. A lot of people didn't hedge for it. So, which means that people don't think about it normally, but that means they're taking interest rate risk. And that they should be very cautious when you take interest rate risk. And so this, as you said, this could put pressure on the system.
High yield. There's been so much demand for it. Never mind that inflation is sticky. Is this worrying or not?
Well, you mentioned at the top, there's a little bit of exuberance in the marketplace. Yes. Personally, I'm not a buyer of credit spreads. I am not that interested in what other people do. I would not buy credit spreads at these levels. And other people have other views, but a lot of people out there, remember, they have passive funds buy it. People have to meet indexes. There are a lot of reasons people have to buy, and they're just trying to create a little bit of alpha for themselves, as opposed to would you go absolutely long credit spreads or not. So I would have the luxury of saying we don't have to. Now, of course, we're in the business, so we continue to make loans that I think may be more stressed than people think, but that's part of a long-term strategy. That's not because I like it at this price.
But the thing is, there's so much demand. What's behind that demand? Is it that complacency, I suppose?
Yes, but demand changes. People forget sentiment. If you look at, what happened before the crash of '73, or the crash of '82, or the bond market in '94, or the crash of 2000, that was all true. And then things change. And even if things change about when people talk about liquidity, well, what happens when things get tough is sentiment changes and people want more cash. And so the liquidity requirements change. Money supply changes. Central banks change. Banks pull back. And that all can pull liquidity out of the market at precisely the wrong time. And when people need cash, they sell risky assets. So you might predict that's all going to happen? No, but I wouldn't be surprised that happens.
It's not just about markets, it's about AI, it's about tech. I mean, JPMorgan has come out to say it is actually a tech company that just happens to be a bank. You have a huge tech budget, I think $9 billion, $3 billion for $20 billion, and then I think $3 billion for cybersecurity. Talk to us about how you're mobilizing that capital. Yeah, Where are your areas of priority?
So we don't actually deploy capital by saying we'll put capital there. We in everywhere we do, in every business, we grow in China. Like here, if you look at just China, we've gone from banking 10 companies to banking, I think it's 200 or 300. We've gone from banking 30 multinationals coming here to banking 600 multinationals coming here. And as we serve them, it deploys capital. So the deployment of capital, deployment loans are an outcome of building the business. That's true for every country. It's true when we open branches in the United States. It starts to demand capital as people give us deposits. We start to make loans. So we are pretty comfortable we can deploy capital intelligently, serving clients. We don't deploy capital like an investor saying, this is the best place to put it. It's a kind of an outcome of how we kind of grow the business.
In terms of AI, though, I mean, how are you investing?
Absolutely. Well, AI, if you or at any business meeting we have, and we've been doing it for 13 years, at every business meeting you have, we talk about how you can use technology to do a better job for your clients. What are the projects you have? So we're using AI for risk, fraud, marketing, design, document management, who you should call in the morning, Salesforce type things, branch location, hedging, and it's the tip of the iceberg. It's moving very, very quick. Coding is moving very quickly, so we want to just stay up there and use AI to serve our clients. And we're going to do that. How can I do a better job for our clients using a technology called AI? Just like we did it with a technology called digital, a technology called cloud, and way back a technology called mainframe. Like, it's no different. we got to do a better job for a client because that's how we compete.
So how will JPMorgan look like in 3 to 5 years on the back of developments in AI?
How will what?
How will JPMorgan look like? I mean, how will business?
I hope it's thriving, but like, what's not going to change? People are going to have to hold money, move money, invest money, raise money. I think how that happens will probably change. You know, we use blockchain. There may be more blockchain being used to do that. There may be more people in AI jobs and less people in certain jobs. You know, so it'll all morph, but that's our job to serve the client. And of course, you know, I always point out that in the old days, we had, you know, the big banks were our big competitors, and the investment banks, and that was global. Different banks in every country. Now it's fintech in every country. And they're good. You know, a lot of these people, Revolut, Stripe, and Citadel, they're quite good. So we have to compete with all. And a lot of that competition will be technology and AI. So we are investing that money to be competitive, to do a better job for our clients. And if we're not fast and nimble, we'll lose.
And you're fast and nimble, right?
Sometimes we're fast and nimble. Sometimes I feel like we're a dinosaur and an elephant riding a bronco.
It is about manpower in the end. We've had the likes of
women power.
Manpower, women power. It's about the workforce. We heard from Standard Chartered shedding about 8,000 jobs over a spread of 3 years. We also had Meta saying it's shedding the same number of people. I mean, how are you looking at manpower, women power? How are you looking at the workforce on the back of, you know, advances being made in AI?
I think the most important thing is we do a good job for our clients and use AI. Will it change the structure of jobs? Yes. I think there have been very few announcements that are AI related. I think a lot of companies have too much bureaucracy, and they may use AI to cover up the fact that they should never have hired those people in the first place. But AI is going to change jobs. I don't know. I think it'll reduce some of our jobs down the road. I don't think it'll be all different types of jobs, and you have to deploy it at a level. Like I think we'll be hiring more AI people and probably less bankers in certain categories, and it'll make them more productive. So when you get up in the morning and you want to interview someone, it'll lay out what I've said in 14 different places. It'll give you questions. Your job will be the same. You'll just be much smarter at how you execute that job. So,
but I guess the question
but we will retrain and redeploy our people. You know, we have 10% attrition a year, which means our headcount's going down 25, 30,000 a year, and we're going to be prepared to say, okay, we love these people, they're great, we're going to take care of them. We're going to give them reskilling, new skills, better jobs, move them somewhere else, maybe early retirement. And then I think society maybe need to do a little bit of that. Get prepared, and in my view, that's got to take place locally. So some jobs are across the nation, like AI and cyber and maintaining certain types of equipment and cars. Other jobs are very specialized. You know, this is a mining town, and that's a car manufacturing town, and that's a chemical town, and so the local schools, and that's, I mean, high schools, community colleges, and colleges should work with the local business. Say, I'm going to give these kids certificates in the 12 weeks or 1 year of training they need to have that job. There are going to be 8 million trade jobs, which pay $100,000 a year available in the United States in the next 5 years. Okay, so it's not, we're not helpless. We just have to get prepared, kind of have a plan. The plan is if it happens too quick. It may not. But my view is whenever you think there might be a risk, prepare for it. And if it doesn't happen, so be it. Most of the stuff you did in preparation, you should have done anyway.
I just want to be clear. So yours is basically about natural attrition. You're not looking to perhaps downsides because of the efficiencies of AI. That's going to.
It will cause that, but you know that happens in that's been happening my whole life. I mean, if you look at all our jobs, they've always been changing how you do jobs. But we will do it to do a better job for our clients. And yes, it will reduce some jobs. We know that. I can't tell you specifically what, because you know it's kind of at the early stages. It is every app, every process, every job will be affected. Some will be more productive, some will be not enough jobs, and then we'll help our people, you know, have a good career.
Jamie, there's been a lot of backlash on social from what Standard Chartered CEO Bill Winters said. He talked about how, you know, AI will wipe out the lower value human capital, and a lot of people took issue with how clinical and how cold and how perhaps insensitive that was. Can you weigh in on that? I mean,
okay. Bill's a friend of mine, and all of us say something incorrectly. He's already come back into, you know, taking that back. It was an inartful way to say something, but I also think it'll be all jobs. I don't think it'll be higher level, lower level. I think it'll be more than you think, but it also will create some jobs. So, you know, in some ways, if you know, back office jobs disappear, we need more front office jobs to cover more clients. So So look, you get a lot of noise from this. I see all the backlash in data centers and AI. I do think it's incumbent upon us, society, to think through, if it happens too fast, what do we do about it? You aren't going to stop it all, and you can talk all you want, do the work, get prepared, take care of your people, take care of society, and I think we'll be okay.
We hear that you'll be speaking to New York Mayor Mamdani along with David Solomon. Of course, we know he wants to increase taxes for the wealthy in the city. What's the message you're sending him? What will be your conversation with him?
I did meet with him, and I told him exactly all the great things that JPMorgan does, the employees, the taxes, the philanthropy, the biggest, in New York, the biggest affordable lender, how we take care of our people, how they all get medical, the minimum wage is $25, just so he understands. And that a lot of what we do in New York is exported around the world. So it's a huge export for the United States, a competitive advantage for the city and a competitive advantage for the United States of America. And then we're good citizens. And we always have been, and we talked about affordable housing and child care, which are his two things. Well, of course. Everyone I know thinks we should do more affordable housing, but I told them it's smart policy that gets that. You can say it all you want, but if you watch governments, they do some things that have the absolute opposite effect of what they say. And I can go through a million examples. Same for child care. It's got to be done right. It's got to be done effectively. It's got to be place-based. It's got to work. It's got to be thoughtful and stuff like that. Every city, but he had read my chairman's letter, and we went through that every city has to compete. And they have to compete at every level, arts, science, schools. That is what it is. I'm not inventing that. He can be an ideologue. He has to compete too. And we'll see. Will he learn that he's got to make the city a place where people want to grow and build and live and have families and work? And he's got to compete with Shanghai and Hong Kong and Singapore and Nashville, and people vote with their feet. So it isn't this morality thing that people talk about. It's like, are you building a great city with lower crime and stuff like that? I also want to point it out that I did mention to him, because it's important to me, that I am against racism of all types, including anti-Muslim racism, anti-Jewish racism, which I consider anti-Semitism, anti-Jewish, and I think Israel has a right to have a state. So I think there's a little confusion between anti-Semitism. So you may not like what a country's doing. I don't like what Iran is doing. It doesn't make me anti-Muslim. And so I think we have to be a little careful of this, but I want to be absolutely clear. And he acknowledged it, and he said, I think, he kind of agrees.
I want to go back to the taxes that he wants to impose. At what point do you think those taxes will make New York less competitive? At what point do you think, there'll be an erosion of talent within the city?
I think it's already doing that. In my letter, I pointed out that and these are just numbers. JPMorgan, when I got there, had 35,000 employees in New York City, and now it's 26,000. We had 12,000 in Texas, and now it's 33,000. That is because of individual taxes, corporate taxes, state taxes, but also the schools in Dallas. They've become very good. The life in Dallas. The Dallas mayor calls up all the time saying, what can I do to help you? I have land over here. I have, and that is pro-business and pro-people love living there. And that's what New York City, now New York's a wonderful place too, but that is the result. When I grew up in New York City, and this is an amazing number, in the 70s, they had 120 of the Fortune 500 were in New York City. In those 10 years, or about those 10 years, 60 left or failed or merged out, mostly because of things like taxes and crime and stuff like that. And those are big names like GE, IBM, American Airlines, and is that what you want? And that's what people seem to want. They think that somehow being anti-business is going to help a city. It's not. So we all want to pay fair taxes. That's not the point, but at one point people vote with their feet, and there are a lot of studies that have shown that all these people moved out, and they're obviously New York's booming, so you're not going to see it in this year's taxes, but a lot of people are paying billions of dollars taxes left. Why do you want that? How does that help the lower paid person in New York?
Just one final question before we let you go.
I also, when I hear these people talk, when they say fair taxes, fair share, what do they mean? Like, I agree with the fact, if it were up to me, I saw Jeff Bezos, who I love, swashbuckling, fighting. I don't think the lower people making under a certain amount have to pay any taxes at all. I would agree with that. But when they say fair share, what do they mean? I mean, they should give a number and say that's a fair share. So we'll see. So
what do you make of the beef Mamdani has with Ken Griffin? I mean, there's been a lot of pushback as well from...
my view is, I didn't speak to him about that. I think he realized he made a mistake in naming Ken vilifying a name and a person. And my grandparents were all Greek immigrants. Okay, I've been working my ass off now for a long time. I think vilifying people, simplifying arguments, even if you think it's politically expedient, is a bad idea. And I think he probably realizes that was a bad idea. It's probably why he's seen a bunch of us now. I'd like to maybe have a better relation with the business community. But we'll all be doing the same thing. What does he do? I don't care what he says. What does he do? I will judge that. And so will what actually happens, because you can talk about morality and ideology all you want, but if things don't get better, you didn't do a good job. And in my view, and I'm talking about him now, I have seen mayors who make statements and they make it worse and worse and worse. And they don't know, they can't get into the details of why is affordable housing not there anymore? Why does this not work? And so hopefully he'll learn. I want him to do a good job. I'm not against him. So,
Jamie,
yeah.
I'd be remiss not to ask you about China. We are in China after all. We saw that, warm chemistry between the two leaders, Xi Jinping as well as Donald Trump. Does that change your perspective on China and perhaps, the appetite for investments here?
Not really. Look, I think we have China and America have real differences. And I think these wars also highlight that, America, we want Ukraine to end up as a free and democratic state. I'm not saying, I don't know about the war, but I'd like to see Iran end up without nuclear weapons and no one controlling the Straits of Hormuz. And I also object to the notion that somehow Iran wasn't a threat. They've been killing and murdering people for 47 years. That's not a threat. Okay, and a lot of Americans, a lot of Muslims, a lot of Jews, a lot of other people, they've been having proxy wars, for 40. I don't know why you even allowed these proxy war thing. That makes it more complicated. But and put Taiwan aside, America and China have a lot in common. Okay, we want to help our people. This country's grown dramatically. I think that's a wonderful thing. We have a lot of common interests in anti-terrorism, anti-nuclear proliferation, the proper control of some of these AI things which can damage society. So they should engage all the time at every level. Work out the trade differences. There were going to be some real differences in that, and then have a good, proper relationship. I think it's good for both. I think it's good for the world. The world has got to deal with these two huge, powerful countries, and we should help each other and help the world. And so, I like the fact they did it. I applaud they're doing it.
What's the biggest risk for the Chinese economy right now, you think?
The Chinese economy? They've been very smart in managing their economy for years, but I would say too much reliance on exports. They know that. That's been in their plans. That irritates a lot of the countries around the world. I think that their neighbors around the South China Sea are getting quite upset with them about their behavior in the South China Sea. Not because of anything that America does. And trade. We should work out trade in a way that doesn't damage the global economy. So. But they've been quite, and also some of the capital allocation in real estate and some of the local stuff. But my experience with the Chinese is they kind of know these issues and they kind of go about attacking them strategically, correctly over time.
But is there a sense that China has become somewhat of a safe haven given, all the chaos elsewhere in the world?
No, but it's somewhat artificial. I mean, America's still a safe haven. I mean, we just surprised people, that recently, but we're still probably one of the safest countries in the world, the best investment destination in the world, the most secure rule of law. When they give you $1, you can do whatever you want with it. But China has become a large, important country, and I applaud that. I'm not against that. And they, of course, think that they're more consistent with other countries. That's been true a little bit recently. So that's not forever. That's recently.
But is that changing the perception of investors, though? I mean, are they looking to China as...
A little bit. But if I was an investor, I'd always be looking at a place like China. When you look at China, when any investor comes here, you just have to be impressed with their cars and their batteries and their solar and their machine tools and their capabilities. So, of course, that's how investors are seeking out opportunities around the world. There'll be plenty of opportunities here.
I've been messaged and I was told to wrap it up. Jamie, always a pleasure. Thank you for joining us on the show. Jamie Dimon, Chairman and CEO of JPMorgan Chase. Now, here are some of the stories we are following. The U.S. and Iran have traded threats of escalation. Even as President Trump says the U.S. is in the final stages of the conflict, Iran's President Masoud Pezeshkian posted on X that forcing surrender through coercion is an illusion and calling for mutual respect. Tehran has also warned it would retaliate beyond Middle East if the U.S. or Israel renew strikes.
Everything's gone. Their Navy's gone. Their Air Force is gone. Just about everything. The only question is, do we go and finish it up, or are they going to be signing a document? Let's see what happens.
President Trump says he will speak with Taiwan's President Lai Ching-te as Washington weighs a $14 billion arms sale to the island. It comes after Trump's summit with Xi Jinping, where the Chinese president warned mishandling Taiwan could push the two powers toward conflict. Trump earlier said he did not make any commitments to Beijing about the pending sale. And Russian President Vladimir Putin has left Beijing after a day of talks with his Chinese counterpart Xi Jinping. The two leaders signed a pact on deepening strategic cooperation and other agreements ranging from trade and technology to railway construction, but there was no mention of a key gas pipeline project. Xi also called for a comprehensive ceasefire in the Middle East conflict. China has cut government spending at its fastest pace in 6 months in April, contributing to an unexpected slowdown in the economy. Bloomberg calculations show a broad measure of public expenditure fell 7.3% from a year ago, while fiscal revenues rose 2%. Beijing is still expected to ramp up infrastructure investment this year to support growth. And Beijing plans to impose mining controls on certain strategic minerals to ensure supply security. State media says the rules will take effect from June 15th, allowing caps on total output and mining operators. Plus, foreign investment reviews on national security grounds. Officials did not specify which minerals will be affected. And still to come on Insight, India was the foreign investor favorite over China, but AI and the Iran war have flipped that narrative over the last 12 months. We discussed that with JPMorgan's head of Asia and co-head of Global Emerging Markets Equity Strategy. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Global investors expect the Indian rupee to weaken further, with some even gaming out scenarios where the currency falls to an unprecedented 100 per dollar. A prolonged stalemate in the US-Iran war is pushing up India's oil import bill and driving investors towards the dollar. Let's get more from Mumbai and our Asia EM FX and rate reporter Malavika Kaur McCoy. Malavika, how soon are they seeing this 100 possibility?
Yep, they are seeing a weakness in the currency, with some of them even talking about that 100 level, which is a psychologically important threshold here in India. Of course, some of the weakness, for some of the reasons why we're seeing this weakness, is the energy price shock. India is a net energy importer, so every time oil prices go up, it affects the currency. But even before that, we had a lot of foreigners pull money out of the stock market, so that has also weighed on the currency. So that is leading to conversation about further weakness in the currency, and that is leading to conversation about that big 100 rupee mark.
How much support can be given by the government, by the RBI? So far, we know those measures have not worked.
Yeah. I mean, there's some that they've already rolled out, which you alluded to, some of them being some sort of restrictions on gold and silver. The RBI has also been intervening, and India is also considering a plan to lower the taxes paid by foreigners on their bond holdings. The rupee has weakened even then, so analysts do point to the fact that more needs to be done, especially on the foreign fund side. Like, the RBI and the government needs to do something to get those flows back.
Malavika, thank you so much for that. Our Asia EMFX and rates reporter Malavika Kaur McCall. Now, Indian stocks, last year's consensus darling, are facing a sharp reality check. Foreign investors have fled the market, pulling a record $22.4 billion this year alone and dragging the Nifty down nearly 15% in dollar terms. Meanwhile, capital is rotating fast into China, driven by a massive AI tech boom and surging demand for hardware supply chains. Mainland equities are staging a striking comeback, with the tech-heavy China index gaining 20 27%. For more on these shifting flows, let's bring in our markets reporter, Anthony Stevens. And Anthony, are investors just paying the AI premium when it comes to China over India, or is there something else going on here?
It's a bit more structural than that, than just paying the premium. You're seeing China embracing AI, and India is getting disrupted by AI. And that needs to resolve itself before this trend reverses, right? So China has a domestic tech ecosystem that was supercharged by kind of US restrictions on chip buying. Those stocks are doing really well. And you see that following through today, even after the NVIDIA earnings. India, on the other hand, still has to find its footing in the AI world. What are all these IT outsourcing companies, coding companies going to do when AI can do the coding for you? And you've seen those stocks lag materially. There's been a little bit of reversion more recently as that trade kind of unwinds. The Indian tech sector has found its feet a little bit, but that's by returning cash to shareholders. There have been buybacks, there's been dividends. These are not the kind of things that will turn this mega trend around. For that, you do need earnings growth. You do need a new narrative. And for now, only China has that kind of driver.
And what are the prospects of that going forward? 12, 24 months from here, how much clarity is there in terms of earnings in India? Might that provide that turnaround?
So we're starting to see more partnerships between the US tech ecosystem and India's tech ecosystem, right? That geopolitical nexus is alive and well, and that's starting to produce data center investments, training collaborations, and these kind of things. But the revenue behind those initiatives has yet to come through. So maybe in 2 to 3 years' time, the Indian tech ecosystem will start to be a collaborator on new LLM organizations. But for now, we don't see that.
All right, Anthony, Bloomberg market reporter there for us. JPMorgan has cautioned that India's corporate earnings face significant risks from an extended energy and logistics shock linked to the Middle East conflict. It's warning that the Nifty 50 could slip to 20,500 in a bear case, even as it maintains a 27,000 base case target amid fragile macro signals. Joining us now is JPMorgan's head of Asia and co-head of global emerging markets equity strategy, Rajiv Batra. Rajiv, good to have you with us. So kind of like square that for us when it comes to the prospects for the Indian market.
So we started with this year on a macro recovery and the growth recovery for India, but that story got short-circuited. One, because of the West Asia conflict, and second, the higher oil prices overall. So now we are in a situation where you are seeing a two-speed recovery within the India per se, or the typical what we learned under COVID, the K-shaped recovery that has started emerging. The ongoing earnings season, it is not giving us a true picture what is about to come, because there will be definitely some amount of a hit coming to the growth, coming to the macro variables overall, and it will either show up in form of a demand destruction or margin reduction, or even I will say operational, where smaller companies and even some are not operate because of energy not available. And then lastly, which people cannot count, the second order impact, which means the consensus earning growth number, which is right now at around 16% mark, can about to get downgraded further. So we are estimating number should be around 11%. But in case if this Hormuz, which is shut for a longer, then the pain could be much more longer. Right now, it is fair to say first quarter FY27 will be a washout. But if situation prolongs, second quarter FY27 can come also under trouble.
So despite the sell-off we're seeing in India right now, it's still not reflected what's possibly coming.
Not yet, because valuations are still higher, growth is sluggish, and most importantly, the narrative around the AI impact on unemployment or what will happen to the IT sector is still being talked, but not fully in the price overall.
So sell India still? I mean, it's being supported right now by the retail investors. You got to wonder how long that can be maintained.
You don't have too much alternatives over here. When we look at the tax advantage when you invest into the equities compared to fixed income, compared to real estate overall, you are still advantages investing into the equity from the longer term lens, 12 months and beyond. And that's what retail is trying to do. It is not a broad-based country sell story, but there are certain amount of a sector which will take a hit, and consumption is one of them, which is on the receiving end. But the sector which are being supported by the policymaker, like we saw in the budget, that the new age capex-oriented sector, new age industries on AI, robotics and tech, they may still see the growth. So hence, this is the reason why there will be a cohort of domestic cyclicals, which we are positive on. You will definitely make a lot of money on that. But the sectors which are on the receiving end, hit by the urban consumption slowdown, or maybe rural taking hit due to El Nino, that is where the problem lies for India.
We're seeing a revaluation story in the Indian market against a backdrop of money gravitating towards China.
Yes.
So might that accelerate the sell-off that we're seeing in India?
Right now, it is just as a starting point or a cusp. It has not fully happened yet overall. We need more evidence, because right now investors are still skeptical whether they will get an equal or a higher amount of a growth what you are generating from the other North Asia peers, that is Japan, Korea and Taiwan, because of the AI capex and the tech hardware team. But beyond this theme, what investors were looking for, property recovery, consumer sentiment getting better overall, policymaker support, that repairing sign has started appearing in China. This is what people are waiting since 2021, 2022. That is what is now eluding within the conference. Also, we are seeing people are talking about, yes, the old economy slowly, steadily making a comeback. The comeback needs to get converted into earnings growth. If you get a high teens, double-digit earning growth, then yes, you can say China sustainably back in the picture.
For India, before we move on to China, the rupee keeps testing new lows no matter what the government does, no matter what measures are being implemented. Where is the floor? I mean, what would it take for the Indian rupee to finally find a floor?
Difficult to ascertain the floor in this environment, because you are seeing what's happening in the global bond markets overall with the way rates are reacting. Top of it, with the current account deficit number being higher, import bills higher because of oil overall, you will need big bazooka kind of a measure, be it on the FCNR deposit side, be on the swap programs which we have just seen overall. In some sense, we need to do some demand destruction also, which we are seeing by the gasoline and diesel hike that has happened for the last few days overall. That needs to continue overall. That can achieve the balance or get you the oil price import level, what country wants over there as such. Till then, most of the heavy lifting has to be done by the RBI in terms of what they are guiding to the bond investors, to the fixed income markets overall. We saw one of the neighboring countries or other peoples have already started raising rate to protect the currency and get the stability in overall. So we are currently at that situation where stability is paramount importance over growth.
But we know that central banks, including the RBI, are stuck between a rock and a hard place. Do you address inflation? Do you address growth? I mean, what are the chances that we see a rate hike, or rate hikes for that matter, from the RBI? How soon might that happen? I mean, we saw how even Bank Indonesia, came up with a 50 basis point hike because it needed to address the weakness in the currency.
Yep. So we are in a regime shift mode. When we started this year, before war, it was a Goldilocks scenario. Like global growth was above potential, 80% of the global central banks was on the easing term. But once this war broke out, post that, we are into a stagflationary tilt kind of a scenario where we still believe that the inflation is transitory. Inflation is not here to stay, because if you remove oil and food out, the core part or super core part of the inflation is not uncomfortable zone for the central bank side. At that moment, when you are already on fiscal end where increasing oil prices leading to demand destruction, if you start increasing borrowing cost, the growth will go to downhill over there as such. So taking that scenario into account, you can anticipate that for now the pain could be there, that you don't hike overall. But in case, like other countries, as you mentioned, where the currency started depreciating at a faster pace, there was no other resolution left rather than going straight forward for a hike. But in case of an India, as I highlighted earlier, there are still a number of tools available, like you can go outside, do quasi-sovereign or sovereign dollar bond raisings overall, beside the FCNR deposit.
And you see that India doing that?
It has happened in the past, so why not bring the same playbook over again? I'll not say the situation is as dire what we saw during 2013 tapering scare, but we have playbook and tool available to, you can say, control the situation.
And we just have a story out of India right now. The Reserve Bank of India is considering all of its available options to stabilize the rupee, including an interest rate hike, more currency swaps, and raising dollars for investors overseas, according to people familiar with the matter. Of course, this is a Bloomberg scoop. I mean, like you said, they're exploring all options.
Yes,
will
exactly.
they work? Which one will work, or all of the above is needed?
Rather than doing one, RBI will need to go big.
By that you mean?
Big means all kind of measures, because you remember there are three asset classes in a play: equities, rates, as well as your currency. If you will just, let's say an example of a measure of declining your current account deficit, who takes the hit? Growth takes the hit, and equity will be the only one which will show up. If you don't do on the current account side and just go for the rates and this kind of a situation, who takes the hit? Your bond market takes the hit. So point is, rather than using one single measure, you should use plethora of measures so that the hit is being taken across all the three asset classes.
The thing is this, right? Part of the reason in the weakness of the currency is the exit of foreign funds. Foreign funds continue to make an exit, and until there's a reversal in that, the Indian rupee will continue to be weak. So no matter what measures are implemented by the government, by the RBI, the weakness in the currency will persist. Is that a fair assumption?
That's a fair assumption, and we need growth, we need sustainable growth, and we have to see whether we have a push factors to bring the foreign money back or the pull factor. For the long time, low-cost labor has been the factor. Right now, the factors which are bringing money into the emerging market like Latin America is commodities, money which is coming to North Asia, that is AI and tech. So factors keeps on changing. Right now, both these factors, either commodities or you can say the tech, hardware or AI space, are missing in India, and foreign investors are missing.
And Rajiv, it's not just weakness in the Indian rupee, or a lot of the other emerging market currencies are getting smacked right now. The Indonesian rupiah, the Thai baht, the Philippine peso. Is that worrying for you, or it's just a matter of waiting it out?
I'll say there are periods which comes, and this is not something new. We had a stagflationary tilt after COVID. Then we had after the SVB issue, and post that we had during after Russia-Ukraine war, and then for a couple of months during the Liberation Day, that is last year in April. We are going through the same stagflationary tilt over there, and that's where the bond market come, or you can say bond vigilante come, and try to tell equity market that there is a law of gravity. You cannot just keep on moving higher. So that checks and balances are coming, but to say that it is something getting worse, situation is getting above like our hand, my answer is no. Because when I look at the deficits level, when I look at the debt to GDP kind of a level, we are in a much more better shape what we were back in 2013, what we were back in GFC crisis era over there, sir. Yes, we are facing a hurdle at this juncture, precarious time over there, and that is a side effect of a stagflationary economy, where people tend to go into the spaces which are non-economic sensitive, which is again today's AI structural theme, and all kind of an economic sensitive zone, which is South Asia, or you can say some part of Europe and Africa. They try to become the funding source or try to take the hit. But we have to trust our policymakers, and time being, they have always shown whenever there is kind of a trouble or a crisis situation, the policy making is best in emerging markets.
But this is the new normal, isn't it? You can say goodbye to rate cuts. You can say hello to rate hikes.
At least I will say, rather than straight going to the rate hike zone, there's a middle path call that I'm turning neutral. Like rather than guiding the market that there is only cut, there is no neutral also. That's what the change in regime can happen. Rather than moving two steps above, straight to hawkish, we can say that the neutral is the new stance which India is trying to convey, RBI governor. And to think about a hike, we need something more. And if war comes to an end, oil price decline, inflation forwards are coming lower, it will resolve most of your trouble. And that's what we saw last night when the news broke out and US 10-year, and then how equities and the bond all reacted. The same thing will happen in Asia also. So your key problem is just one: the Strait of Hormuz. That strip needs to get open.
And when it comes to emerging markets, one stand-up performer is actually Korea. Despite the recent sell-off, it's still up, 70% year to date. I mean, are you still as upbeat? Is it time to be cautious?
That is our number one overweight market. The highest conviction call within EM. We are overweight on Korea, Taiwan, and China, and beyond that, South Africa and Brazil. But Korea stand number one for us, and there are multiple drivers taking Korean equities higher. Definitely, the global backdrop is positive for them. Second, the AI capex and memory chips demand is supporting them. Third, you have the long order book buildup for the industrial sector because everyone is looking for manufacturing and defense resilience overall. And lastly, Korea kept on suffering from the governance-related discount of not having a great governance over there, which is now getting over per se. So taking these factors into account, Korea equities is looking prime to hit our bull case of 10,000.
How soon?
That's our year-end target. So we have revised a couple of times already this year. We don't know next time when we need to revise as we get soon to the 10,000 bull case mark.
What's the biggest risk to that projection, you think?
The biggest risk to that projection will be, of course, the AI monetization. Right now, for last couple of months, the concerns have come down over there as such, but that concerns can arrive again in case if the number of ARR generations are not moving above 150 billion mark, which is the current run rate. If the curve flatten out also, it's not a good situation because with the way the capex is happening, people want this number to keep on inching higher. So that's number one live risk. And second, with the way which the cost is moving higher, both on the power and the hardware side, there could be a time coming where hyperscalers will say how I can keep on funding the margins for the tech hardware companies and the power companies outside.
And that is a key question. Rajiv, thank you so much for that. Rajiv Batra, Head of Asia and Co-Head of Global Emerging Markets Equity Strategy at JPMorgan. Now, still ahead, Elon Musk's SpaceX spot files for a mega IPO revealing billions in losses, while OpenAI moves toward its own debut after Sam Altman's court win. Next, we'll look into what these two listings could mean for global markets. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. SpaceX has filed publicly for what could be the largest ever IPO, targeting a valuation above $2 trillion. The documents also reveal a net quarterly loss of more than $4 billion. Avril Hong joins us with more. And Avril, what else are we learning from this SpaceX filing?
Yeah, this is much anticipated. We're getting a glimpse into the finances of the world's largest private company. And what they're revealing is, yes, revenues have been rising. It was $19 billion last year. First quarter of this year was about $4.7 billion. But really, those revenues are not keeping pace with its expenses. It's been splashing out, spending on cloud, on data infrastructure for AI, but also what you're getting on compute, as well as launch infrastructure for the business. And of course, this is related to some of its expenditure in Starship, the project that is developing for the rocket, $15 billion that has been spent so far, versus what Elon Musk had projected about 7-8 years ago of about $2 to $10 billion. And then when it comes to the AI-related spending, you also see how it's not just spending on some of these compute infrastructure, it's also spending into XAI, which of course, following the merger, it's had to ensure that Grok remains relevant. Now, the other thing that we've been learning from these filings is how Musk is going to be retaining a lot of control on the company because of the shares that he owns. He'll have effectively 85.1% in terms of voting power. And that really speaks to how public investors, essentially, they won't have many ways into influencing governance. Of course, from these filings, we've also learned how Goldman and Morgan Stanley are going to be leading the way in the deal. And as Bloomberg reported previously, we'll see marketing as soon as about 2 weeks from now. Following that, we'll get more details on pricing and then that trading debut on the NASDAQ for SpaceX.
And it's not just about SpaceX, Avril. OpenAI could be next. Talk about this hive of activity in the IPO space.
Yeah, all these AI-related companies are rushing to public markets. For OpenAI, it's quite interesting because it's gone into this legal battle in the past more than 2 years with Elon Musk, and that's sort of been cleared this week because a judge threw out the lawsuit. So I think OpenAI is very, very keen to get this listing on the way, and sources have told Bloomberg that we could see this in a couple of weeks in terms of a confidential filing. It could happen as soon as Friday, and the goal is for it to go public in the last quarter of this year. Now, for OpenAI, this is coming at a time of intense competition with Anthropic, so the rivalry to get to the public markets is there. These developments are really interesting. Haas.
Avril, thank you. Let's now listen back to part of my conversation with the CEO and chairman of JPMorgan Chase, Jamie Dimon, earlier in the show, where he told me how AI is changing his personal choices.
I think we'll be hiring more AI people and probably less bankers in certain categories, and it'll make them more productive. So when you get up in the morning and you want to interview someone, it'll lay out what I've said in 14 different places. It'll give you questions. Your job will be the same. You'll just be much smarter at how you execute that job. So,
but I guess the question
but we will retrain and redeploy our people.
And before we go, here's a look at tomorrow's show. Zuma Wealth founder and CIO Terry Spath will be joining us with her market outlook. Plus, more from the JPMorgan Global China Summit here in Shanghai. We speak exclusively with the CEO of AI biotech firm in silico medicine, as well as JPMorgan's co-senior China country officer. That is it for Insight. Keep it here with us. This is Bloomberg.